Hi everyone, in this video we will explore the core drivers behind a successful options trader. This video doesn't cover all the aspects of options or options trading in general. Selling options premium and the insurance business share a number of similarities. The parallels lie in the concept of risk transfer and how profits are generated. The first one is the risk transfer. When an insurance company sells a policy, it is essentially writing a contract that obliges it to cover specified losses or damages that might occur to the policyholder. In return, the policyholder pays a premium. In much the same way, when an option is sold or written, the option seller is getting paid a premium to take on the potential risk of the option buyer. The seller is obligated to buy or sell the underlying asset at the strike price if the buyer exercises the option. The second one is profitability. Both insurance companies and option sellers primarily make their money from collecting premiums. In the insurance business, profits are made if the total premiums collected exceed the payouts for claims. Similarly, an option seller profits when the options they sell expire worthless, allowing them to keep the entire premium received at the outset. If you equip yourself with the needed tools and skill set, you can operate your in-house insurance business. Here are some general steps you might follow. Choose underlyings. Look for large cap stocks or indexes such as SPY QQQ with a high degree of liquidity, volume, and open interest. These stocks have a more substantial options market which can make it easier for you to enter and exit positions. Sell premiums. Write, sell options on these stocks to collect premiums. You might write put options if you're willing to buy the stock at a lower price, or write call options if you own the stock and are willing to sell it at a higher price. Manage risk. Similar to an insurance company, you'll need to manage your risk carefully. This could involve setting aside sufficient capital to cover potential losses, diversifying your options portfolio, or using hedging strategies. Roll or close positions. If the options you've written are about to be exercised, you could roll the position, close the current option and sell another one, to collect more premium and potentially avoid having to buy or sell the underlying stock. Now we will move on to the core concepts of options contracts. First up, what is an options contract? Options are financial instruments that are based on the value of underlying securities such as stocks. An options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold, the chosen underlying asset at a price set out in the contract either within a certain time frame or at the expiration date. The terms of an option contract specify the underlying security, the price at which that security can be transacted, strike price, and the expiration date of the contract. In the case of stocks, a standard contract covers 100 shares, but the share amount may be adjusted for stock splits, special dividends, or mergers. So now that we briefly went over what the options contracts are, we will move on to one of their most important properties, the Greeks. The Greeks in options contracts are various measures of risk involved in taking an options position. They are called Greeks because they are usually associated with Greek symbols. Each of the Greeks measures a different kind of risk. The four most important Greeks are delta, gamma, theta, and vega. Out of these Greeks, we will first explore the most important, delta. Delta measures the change in an options price resulting from a change in the underlying security. The value of delta ranges from -100 to 0 for puts and 0 to 100 for calls. Puts generate a negative delta because they have a negative relationship with the underlying security. That is, put premiums fall when the underlying security rises and vice versa. Simply put, if a stock price rises, call options prices will also rise while the put options will have a reduced value, provided there are no changes in other variables such as implied volatility or time remaining until expiration. If the price of the underlying asset falls, the call options prices will decline while puts appreciate in value, provided all other things remain constant. Delta is a crucial factor in calculating the probability of an option ending up in the money at its expiration. For instance, an out-of-the-money call option that has a delta of 0.20 signifies approximately a 20% probability of the option landing in the money upon expiration. Conversely, a deep-in-the-money call option with a delta value of 0.95 indicates an approximately 95% likelihood of the option finishing in the money at the time of expiration. Next up on the list is gamma. Gamma measures the rate of change in an option's delta for each 1-point move in the price of the underlying asset. To illustrate, imagine you have an option with a delta of 0.5 and a gamma of 0.1. If the underlying asset's price increases by $1, the delta would increase by the amount of the gamma, thus becoming 0.6. Essentially, gamma reflects the acceleration of an option's price movement relative to the underlying asset's price change. A gamma squeeze occurs when the price of the underlying stock increases, causing market makers who try to stay delta neutral to buy more of the underlying stock. This additional buying can drive the price of the stock higher, leading to a squeeze. It often occurs when there's a high volume of options contracts compared to the volume of the underlying stock, especially when many of those options are near the money. Next up on the list is Theta. Theta is a measure of the rate at which an option's price will decrease or decay over time, assuming that everything else remains constant. This measure is also known as the time decay of the option. The value of theta is usually negative for purchased options, and the closer the option gets to its expiration date, the faster the rate of time decay. Essentially, theta works against the buyer of the option, as the option's value decreases over time due to time decay. However, for an option seller, theta works to their advantage. When selling premium, writing options, the seller benefits from the erosion of the option's value as time passes, assuming all other factors are constant. That's why selling options rather than buying them might be considered a strategy that takes advantage of theta decay. The 45-21st day rule comes from historical data analysis on the optimal time to benefit from theta decay. Generally, options are sold 45 days before their expiration, because this period typically experiences the most accelerated time decay, maximizing the potential profitability for the option sellers. However, these positions are often rolled or closed and reopened with a later expiration, or closed when there are 21 days left to expiration. The reason for this is that while the last few weeks before expiration have very rapid time decay, they also come with increased gamma risk. As options get very close to expiry, their delta can change rapidly for even small changes in the underlying price, making the position much more sensitive to price movements. So, by rolling the position forward at 21 days, option sellers can maintain a balance between maximizing time decay while managing their risk effectively. And finally, we have the Vega. Vega measures the sensitivity of an option's price to changes in the volatility of the underlying asset. Vega represents the amount by which an option's price will change for every 1% change in implied volatility, all else being equal. For instance, if an option has a Vega of 0.10, the option's price will rise by 10 cents for every 1% increase in the underlying asset's implied volatility. While Vega does not directly calculate implied volatility, it is used to gauge the impact of changes in implied volatility on the option's price. The implied volatility itself is determined by using options pricing models, like the Black-Scholes model, in reverse. Instead of inputting volatility to get the price of the option, market participants input the current market price of the option to solve for the implied volatility. This leads us to the next and the most important part of our content today, the implied volatility. Implied volatility is a metric that reflects the financial market's expectations of future volatility in the price of a specific security. In the context of options trading, implied volatility is a critical component of options pricing models. It gauges how much traders believe the underlying asset's price will move in the future. It's important to note that implied volatility does not provide directional insight. It merely predicts the magnitude of price changes. Implied volatility changes due to shifts in market sentiment towards the future price movements of the underlying asset. Specifically, IV tends to rise when the market anticipates larger price swings, regardless of the direction, and it tends to decrease when the market expects smaller price movements. Certain market events can cause implied volatility to increase. For example, earnings calls are a common catalyst for significant IV increases. The reason for this is that earnings reports provide new information that can significantly impact a company's stock price. This can include data on revenue, net income, future guidance, and other financial metrics. Given the potential for substantial price movements following earnings announcements, traders and investors expect higher volatility, leading to an increase in implied volatility for options on that stock. However, it's also common to observe a volatility crush after the earnings announcement, where the implied volatility decreases rapidly. This occurs because the uncertainty is resolved once the earnings information is released, and the market's expectation of future price volatility decreases. This volatility crush can significantly affect the price of options, and it's an important factor that options traders take into account when planning their trading strategies around earnings announcements. Now we will move on to two crucial concepts involving implied volatility, IV rank and IV percentile. Implied volatility rank or IV rank and implied volatility percentile or IV percentile are two metrics used by options traders to determine whether the current implied volatility is high or low for a given security relative to its historical levels. They both provide a context for the current level of implied volatility and can significantly influence trading decisions. IV rank measures the current implied volatility against its highest and lowest values over a specific period, typically the past 52 weeks. The IV rank is expressed as a percentage. A high IV rank, close to 100%, means the current implied volatility is near its highest level for the given period, suggesting options are relatively expensive. Conversely, a low IV rank, close to 0%, indicates the current implied volatility is near its lowest level for the given period, suggesting options are relatively cheap. IV percentile, on the other hand, tells you the percentage of days in the past year that the implied volatility was lower than the current level. For instance, an IV percentile of 70% means that 70% of the time, the IV was lower than the current level. In terms of application, these metrics can help traders make more informed decisions about their trading strategies. For example, when the IV rank or IV percentile is high, it may be a more favorable environment for option selling strategies, like writing covered calls or selling puts, as the option premiums tend to be higher. Conversely, when the IV rank or IV percentile is low, it may be more beneficial to use option buying strategies.